There is a lot of money to be made in the business of money. I don't think that's a surprise to anybody, but do you really know how much of your money may be being lost to the investments you choose to invest in? Now, I'm not talking about market crashes here. You only ever truly lose money during those if you sell your investments during the crash. If you're able to wait out the crash without selling your investments, then the loss never really makes it past the stage of just being on paper. So no, I'm not talking about that. I'm talking about one number that's attached to a mutual or index fund that you're investing in that could end up costing you $1 million or more over the course of your life. Today, that's the number we're going to be talking about. We're going to be talking about the $1 million decision that all of us make when we're making investment choices, and what you can do to make sure you end up on the best possible side of that decision. Let's get started. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. So, many of you have probably already guessed what the number I'm referring to is. It's the expense ratio of any mutual or index fund in your portfolio. An expense ratio, sometimes also referred to as a management expense ratio or the total expense ratio for those who don't know, is basically a way of telling us how much of the mutual fund's assets are used for administrative and operating purposes. The percentage is calculated by taking the cost to operate and maintain a mutual fund and dividing it by the total amount of assets that fund has. The costs associated with operating the fund include paying for things like fees that are paid to the fund's investment manager or advisor, record-keeping costs, custodial services, legal fees, as well as taxes and other accounting service fees. So they are absolutely necessary for us to have the options to invest in these funds to begin with, but it would be beneficial to all of us to keep an eye on them and make sure we keep them as low as we reasonably can. Now, I've talked about expense ratios a couple of times before in some of my much older videos comparing passive and active investment options, because there's usually quite a striking difference between how much money you'll effectively be paying to have most actively managed mutual funds as opposed to more passively managed index funds. But since those videos were made so very long ago that many of my new viewers probably haven't even seen them, and since expense ratios weren't really the primary focus of those videos in the first place, I wanted to make a video specifically dedicated to this concept. With that in mind, just how big of a difference is there when it comes to investing performance and your future net worth if you invested in funds with high expense ratios instead of investing in funds with low expense ratios? Let's say that John and Jane invested in a fund that charged absolutely no expenses whatsoever. They had $10,000 worth of savings to throw in there right away, and after that they invested $500 a month for 40 years. On average, they received returns of 8% per year over that time. After those 40 years have passed and they're ready to retire, they would have amassed a net worth of roughly $2 million. In this perfect world, John and Jane could live on about $80,000 a year in retirement, plus anything they may have coming in from Social Security, pensions, side hustles, or other sources. Not bad. But now let's throw some expenses into the equation. As I've covered in previous videos, expense ratios can vary, sometimes quite a bit from one investment to another. A general rule of thumb that many financial experts throw out there is that you should try to keep the expense ratios of the funds in your portfolio under 1%, if at all possible. And there are many index and mutual funds that would fall under that limit, but not all of them do. Some of them go as high as 2 to 2.5%. So first, let's say that John and Jane decide that they will invest in an index fund with an expense ratio of 0.04%, which would be right up there with the best rates in the industry, at least as of this writing. They still have that $10,000 worth of savings to invest right away, and they'll still continue to invest $500 a month over the course of 40 years. They still have average returns of 8% per year during that time. And at the end of 40 years, they would end up with a net worth, after adjusting for expenses, of about $1,975,000. This means that, in comparison to a hypothetical fund that had absolutely no costs associated with maintaining it, John and Jane spend about $25,000 over the course of 40 years to get that 8% average annual rate of return. That averages out to about $625 a year, or a little over $50 a month. Which may sound like a lot, but you gotta remember the trade-off we're making here. Of that $1,975,000, $1,725,000 of it was interest. John and Jane only invested $250,000 of their own money. So in essence, John and Jane traded $50 a month in expenses to get the opportunity to invest in something that averaged out to have nearly $3,600 a month in interest coming to them over the course of 40 years. That's a pretty good return if I do say so myself. And even this savings would allow them to have a decent income in retirement of a little under $80,000 a year according to the 4% rule. Again, plus anything they got from other sources. But as I said, not all investments have expense ratios as low as 0.04% per year. In fact, it's quite rare to have something with that low of an expense ratio. You can usually find index funds in the neighborhood of 0.1% to 0.3% per year in expenses, and mutual funds often hover somewhere in that 0.3% to 1-point-something% range. But again, like I said, some are much higher. So what if, instead of investing in what was probably an incredibly low-cost index fund, John and Jane instead invested in an actively managed fund that had an expense ratio of 1% per year? If we assume that John and Jane still invested the same amount of money over the same length of time and still averaged that 8% rate of return, they would end up with a net worth after expenses of about $1,483,175. This would enable them to live on almost $60,000 a year in retirement. Still not bad by any stretch of the imagination, but it's definitely a significant difference compared to the index fund's performance. If we compare that index fund to the mutual fund we just used, we see that the difference in net worth was almost $500,000 after 40 years. It averages out to be a difference of approximately $12,300 a year, or a little over $1,000 a month. In order to just break even on that difference, John and Jane's more expensive mutual fund would need to earn them an average rate of return of nearly 9% per year over those 40 years. And the difference between different funds becomes even starker if we look at some of the highly expensive mutual funds out there. For example, what if instead of investing in that low expense index fund, or that mutual fund with a 1% expense ratio, John and Jane invested in a more expensive fund that charged a 2% expense ratio? If we assume that all other factors stayed the same, John and Jane would end up with a net worth, after adjusting for expenses, of about $1,110,300 after 40 years of investing. On the one hand, they still end up with over $1 million in their nest egg. There are worse things in life. But that's not really the point here. The point is that in comparison to that low-cost index fund that performed basically the same in terms of return as this highly expensive mutual fund, the high-cost fund ends up effectively costing John and Jane an additional $865,500 in growth. That's an invisible cost of over $21,600 a year, or almost $1,800 a month. That one number is the difference between John and Jane retiring and living on almost $80,000 a year and retiring and living on $44,000 a year. That is absolutely insane. And what's worse is because of the effects of compound interest, the difference would only get larger and larger the further down the line we go. For example, assuming an 8% return, John and Jane would earn over $157,000 in interest and appreciation on their investments in that 41st year of investing. And that's after expenses, assuming they had the low-cost index fund. But in that same year, with the same returns, John and Jane would only earn $118,500 after expenses with the high-cost mutual fund. That means that in their 41st year of investing alone, despite getting a very solid 8% return on investments before expenses, that high-cost fund is going to cost them $38,500. I know quite a lot of people today that are either by choice or by circumstance living on a lot less than $38,500 a year. Heck, those who follow the Lean Fire movement are actually aiming to, or already are, living on no more than $40,000 a year in retirement. So this is quite a big difference. And as you can imagine, due to those same effects of compound interest, this difference becomes even more pronounced as your rates of return get higher. An index fund like Vanguard's S&P 500 fund with a 0.04 expense ratio that earns, say, 10% per year for 40 years would have had an ending net worth of $3,678,000. A highly expensive mutual fund with the same returns but a 2% expense ratio would have an ending net worth of less than $2 million over that same period of time. That's over a $1.5 million gap, and it's the difference between an $80,000 a year income in retirement and a nearly $150,000 a year income in retirement. But of course, while that all may be true, it isn't the only factor to keep in mind when picking out which investments you want to buy. I understand that, so I don't really want to go too much further and blow this whole thing way out of proportion, because even the highly expensive mutual fund with a 2% expense ratio may still be worth having over the long term if the returns it gets is high enough. So let's go back to the previous example. Say if the highly expensive mutual fund managed to average an 11% rate of return over those same 40 years, instead of an 8% return like the index fund did. In that case, John and Jane would end up with a net worth, after adjusting for those high expenses, of $2,719,300. Which is nearly $750,000 more than that low-cost index fund ended up having with an 8% rate of return. Statistically speaking, particularly in the large cap space, it's not exactly common to find funds that actually pull this off, because not many of them manage to beat their index fund by that much over a period of time as long as 40 years, but that doesn't mean that it's impossible. The key that I'm really trying to make here is expense ratios, while not the end-all be-all, are very important to focus on because over time, due to the effects of compound interest, they have a huge effect on your retirement savings. The key is to not overpay for what you're actually getting. But that'll do it for me today. Once again, if you haven't already, be sure to like the video, and if you want to learn more about investing, you can check out my playlist at the link on the left side of your screen. And as always, thanks for watching.